Now let's talk about operational risk. Operational risk is considered to be one of the most widely used or widely applicable risk in the financial market. So operational risk refers to potential losses flowing from, number one, inadequate or failed internal processes, number two, human error, or an external event. So basically you have every risk covered under operational risk, which is operational in nature. The example that I gave earlier of a rogue trader is considered to be an operational risk by example. The next risk is legal risk. Legal risk is the risk of potential for litigation to create uncertainty for a firm. So you are a financial institution, your responsibility, your main task is to lend money from party A to party B, but party B, after taking money, sue you for some documentation loopholes, for some lack of clarity in the documentation, for some extra chargeability in lieu of service charges. So the risk that you may face because of one party going into litigation is considered as legal risk. The next risk is regulatory risk. So regulatory risk refers to the uncertainty surrounding actions by a government entity. So you are operating in one of the developing markets, and you are expecting the government to be consistent with their laws, with their regulations, but all of a sudden there is a change in the regulatory environment that actually impact your organization. An example is that there is a regulatory change in laws that prevents foreign companies to take profit out of the country for a few years, which may result in revenue deferment. So you had some planning available, you had your strategic planning ready, you expected certain sort of cash flows to be coming in your organization, but then there's a regulatory change in the environment, and now you cannot take your profits out of the company. Of course, the strategy that you may have had, you will have to change it, and you will have to adopt new practices. So the risk that is coming from regulatory practices, or what we should refer as uncertainty in the regulatory practices, would be considered as regulatory risk. The next risk is business risk. Business risk is again volatility in the business inputs that can influence either revenue or cost. So if you are a car manufacturer and the major cost was the car kits that comes to your company, and then you assemble it. If you are a car assembler, let's say, so the increase in prices or this inability of importing these car kits would be termed as business risk. So you had expectation that you would be able to manufacture or assemble 1,000 cars per month, but there is a change in the policy, and now you can import only 500 kits per month. So based on that particular change in the environment, your business would be impacted. Another example is in the oil and gas sector, companies may impacting during prices downfall. So as I mentioned earlier, if the oil price is about $100 per barrel, you are meeting your requirements, you are making a good profit out of it. But if it comes down to $50 per barrel, then you would be losing money out of it. A related risk is a strategic risk. So business risk and strategic risk are generally used interchangeably, but there is a difference between the two. Business risk is considered to be more about the operations of the organization. It's about the business inputs majorly. But the strategic risk is more about the long-term decision making of the corporate. So if there's a risk about the long-term direction of the company, if it's about large capital investment in either equipment or human capital, if there is a problem there, if there is an uncertainty there, if there is a volatility there, that would be termed as a strategy risk. An example is an FMCG who plans to launch a consumer product in a new jurisdiction, but despite heavy investment, the product did not post the sales that it expected. Of course, you had a lot of investment in both equipment and capital, and you would be losing money in there. Now, this is more about the strategic direction of the organization. There were some lapses in setting the direction of the organization. It had nothing to do with the business environment of that particular business. The last risk is reputation risk. So reputation risk is a risk that firm will suffer losses in public perception. This risk is particularly pertinent in this current era of social media. So if you are doing anything bad, if there is any bad publicity in the social media, you may get impacted and you may have a bad reputation in the market, and this reputation is extremely hard to be recovered. An example of reputation risk is there's a rumor about the bank that the bank is closing, and people came out and they start taking money out of their bank accounts. This reputation risk then lead to liquidity risk because they did not foresee it, and they do not have enough cash available in all of its branches, and they cannot just pay money back to each and every customer. So this is a kind of reputation risk which may also lead to liquidity risk. This particular scenario is termed as bank run. Now let's talk about risk interaction and aggregation. We briefly covered it earlier as well, that the major problem with the risk management that it can be highly interlinked. Let's take an example of COVID-19. It was an operational risk in nature. The pandemic ideally comes in the operational risk that we just discussed. And because of this operational risk, all sort of risks were triggered. There was an increase in the credit risk, the default increases, there was an increase in the late payments, the market risk was there, financial markets went down significantly, the liquidity risk was there. So one operational risk in nature actually caused a lot of different risk, and the whole organization was impacted because of this interlinking. Another critical problem is risk aggregation. So ideally what we want to do, this is something that we discussed in ERM earlier as well, that we want to combine all sort of risk in one single number. So for example, if we want to do risk aggregation of a bank, there are a number of risks. So number one is market risk, number two is credit risk, and number three is operational risk. Now generally market risk considered to be more of a quantitative risk in nature. The same goes for credit risk. This is also quantitative, but operational risk is considered to be more of a qualitative risk in nature. There are of course models available using which you can quantify your operation risk as well, and there are organizations who actually do that, but in its entirety, for all practical reasons, the quantification of operation risk is a bit difficult. And since you have two risks which are quantified, which have a number, and there's one risk which is qualitative, first you will have to convert it into quantitative, and then after quantitative you will have to combine it all. So it basically becomes a challenge when you want to aggregate all sort of risk into one single number. The last discussion of this chapter is on risk adjusted return on capital, or RAROC. RAROC is another model similar to what we discussed earlier regarding the value at risk, but it is used for economic capital calculation. It gives us the reward to risk measure that exceeds the cost of capital, and we want to analyze what sort of accepted or acceptable risk adjusted return we have on our capital. For example, we may say that our risk adjusted return on capital would be 5%. So whatever risk we are taking, we want to achieve at least this sort of return if we want to continue with our business. There are of course certain practical applications of RAROC. Number one is we can use it for business comparison. So what we can do, that we can implement RAROC model for different business units, even when there are different levels of economic capital exist for every segment. So there is a business segment A, B, C, D, and it can be 6%, it can be 9%, it can be 3%, it can be 8%. So we can say that business B is doing the best and business C is having issues. So we may consider discontinuing this particular segment and investing more in the B segment. It also assists us in doing the investment analysis. So we can do is from a segment perspective, we can also do it from a product perspective as well. So if we have new product offering which we want to introduce, we may consider calculating RAROC or expected RAROC for this particular product, and we want to again compare it with other products, and then we can decide if we want to launch this particular product or not. It also assists us in doing pricing. So we can use this analysis if to identify if the pricing strategy provides the sufficient returns relative to estimated risk taking. So we may say that the segment B is doing well, the segment C is not doing well, or maybe we can say that basically there's a higher risk already in there, so we expected return to be 2% only for this particular segment, but this is a segment that is critical for our business, so we still want to remain there, but the level of RAROC which is for the segment C, it cannot be compared for segment A, B and D. So you can do it on a comparative basis as well, and then you can decide your pricing. Maybe you can adjust some of the inputs, you can change your pricing, or you can make some business adjustment to be able to identify the right price for you. The last is that it can assist us in identifying the areas where risk is not properly covered with expected reward. So you may be getting a very high return, but it may be because of the fact because you have not just identified the right sort of risk. So we have this term that we refer as too good to be true. So if segment B is, let's say, given 15% on a face of it, it looks very good, it looks very promising, it's definitely outperforming all other segments, but it can also reflect that the risk is not reflected in the right manner here, and this RAROC model, this risk adjusted return on capital model, can also assist us in analyzing that. So this is what we had from this chapter 1. Thank you.